Welcome to the Allan Small Financial Show. Welcome to Liberation Day, although not sure exactly what that means, but we're going to talk a lot about that on our show today. I want to thank everyone, as always, for taking the time out of your busy day to spend it with us. There's been a lot of questions, and I shake my head when I say that. A lot of questions about what's going on, the tariffs. Obviously, we're going to hear a lot from President Trump at 4 p.m. this afternoon. Will that clarify a lot of things? Will that things maybe perhaps make things even more confusing? The hope is that there's more clarity come 4 o'clock, 4 p.m. or in and around 4 p.m. this afternoon. One can only hope. As we know, markets are always looking for clarity and to remove the uncertainty. So instead of uncertainty, markets are looking for certainty and how things will pan out. I guess my hope is that once we know what the rules are and what the president is looking for, that we can begin to negotiate. Canada can begin to negotiate. All countries around the world, or Europe and Asia and Mexico, we can all negotiate. And perhaps when we look back, this will be a moment where global trade system changes for the better, for the foreseeable future. I guess one can only hope. But as always, a lot of questions on the minds of individual investors, and we try to answer them every show. Every Allan Small Financial Show, we try to answer as many questions as you, the viewer, has. So let's put up what our topics for the show are this afternoon. We have 3 most asked questions by concerned investors. I've been getting the same questions asked multiple times by many different investors. We're going to talk about these 3 questions and my answer. I think a very important part of our show today. We're going to take the time to walk through some examples of an actual trade and the environment that we're in right now and how it affects buying or selling a stock. I think it's really important to go through. As always, our top 3 things to consider over the next 5 to 10 business days. These are ideas that, of course, I think investors need to focus on. Some of them right away, perhaps some of them in a few days, and maybe some next week. Potential outcomes of tariff wars moving forward. I think there's really 2 things that, in my opinion, are certain going forward. 2 things that I think you should expect to see. We'll talk about that. Make Canada a tax haven. This was an idea by a famous economist, David Rosenberg, and he had this message that he put out on X or Twitter, and it was a message that I actually agree with. And in my opinion, the best way, and according to David, the best way to be able to fight back against what President Trump is doing to us here with respect to our economy and tariffs. Trump's challenge in rebuilding the manufacturing sector. This is really what President Trump wants. He wants to bring back manufacturing to the United States. Well, unfortunately, manufacturing was gone from the U.S. for decades now. The U.S. is now more of a services economy than a manufacturing economy. A lot of manufacturing has gone overseas. We'll touch on why that is happened or has happened, and how difficult it will be to bring back manufacturing. He seems to think he can do it by, I guess, maybe strong-arming some countries and putting tariffs and perhaps forcing businesses to come back to the U.S. I'm not so sure that's going to happen. Quick hits, 3 ideas, 3 things that individuals have seen in the news today that I think are, that have caught my eye. I'm going to comment on all 3. And last, but definitely not least, as always, I'm going to try and take as many of your questions as I can. We have a couple of questions that we've received over the past 2 weeks. We're going to touch on those, but feel free to ask any questions that you have. We're going to touch on a lot of questions investors have right now, but if you have any others, anything specific to your portfolios, anything you want me to answer, be glad to do so. Put those questions in the chat boxes, and I'd be happy to answer them. If not at the end of this show, definitely on our next show or over the 2-week period until our next show. So without further ado, let's move on to topic number 1. So 3 questions I've been receiving a lot, and we're talking about multiple times by different investors. The first one, And while I talk a bit about that, we can actually show our first chart, which is the S&P 500 year-to-date chart. And this would show with good reason why investors are getting nervous. They're getting nervous. They've been getting gradually more and more nervous over the last, let's call it, month and a half or so. The first question as we look at this chart is from many individuals that are approaching retirement or just entered into retirement. They ask me, or they state the same thing: Allan, I don't have enough time to weather a downturn in the market. My time horizon is a lot smaller. What can we do because I don't have enough time to make back any losses? So that's the first comment or question I get. My answer is very simply, you do. As you move into retirement, from what I've seen in my 26 years, I have not had the experience where an investor pulls out all their money out of their investments all in one shot to live off of. You may pull out 30,000, 50,000, whatever you need, 100,000 to live off of, but the rest of your money stays invested. So if you're pulling out 3% of your portfolio, 4% of your portfolio, the hope for many investors is that whatever's left in the account after you withdraw whatever you need, monthly, quarterly, annually, is that money or those investments can make back what you pull out. And so your portfolio either stays the same or maybe even grows a little bit while in retirement. Maybe that RSP that became a RIF or RIF account at 72 now actually grows a little bit over time. Because as I said, you're never going to need all your money at once unless you're saving for a house or something specific. Most individuals, if you're saving for retirement, when you actually retire, 65, whatever that age is, you need some of your money and the rest of your money stays invested. So if we do experience a downturn in the markets, you are going to be invested for the next 10, 20, 25 years, depending on obviously how long you live. And as I tell people, you're going to invest until the day you are no longer on this planet, till the day you're no longer with us. That is, hopefully you start at a young age, maybe in your early 20s when you get your first job, and you'll be investing well into your retirement. So you do have the time horizon to make things back. So this talk about as you get older, the more you should have in fixed income. Yes, I think that can make sense for certain investors. But for other investors that need growth and more growth, that doesn't make sense. You should be asking yourself always, what do you want your money to do for you? That is a lot more important, way more important than following some rule of thumb that says you should have more bonds in your or GICs in your portfolio just because you're a year older or a few years older. That doesn't make sense to me. You always want to ask yourself what you should be doing based on your investment objectives and goals. If it's growth, well, you can't be in GICs or bonds making 3%. After inflation and taxes, you're not making anything. In fact, you might have a negative return. So always ask yourself, what am I supposed to be doing, or what do I want my money to do for me? And that's how you should be investing. So that's question number one, or comment number one I get most often. The second comment or question I get, and that we can go to our next chart, is basically this idea of when markets are volatile, why don't we take a step back, Allan, move ourselves from the market until the coast is clear, and then we can go back in. Knowing when to get back into a stock, for example, is never easy. That's the title of this chart. And here we have a perfect example of a situation like this. And I'm using today's environment to prove a point here that it is never easy knowing when to buy back in. We can all say, okay, stock goes down, let's sell, take our profits, and we'll get back in later. Well, when is later? When will the coast be clear? When will the storm clouds all go away? Well, I'll tell you, they never all go away. There are always reasons or storm clouds on the horizon for people to be nervous. Some people are nervous when the market goes up because they know that at some point it's bound to come down. So that prevents them from investing. And some people get nervous when the market goes down because it's a pretty negative feeling that there is something wrong in the economy. That's why the market's going down. So fear grips them on both ends and they never invest. So here's a pretty quick example. You have investor A and B. They own a stock. We called it XYZ. And here you have on the left, it goes from $0 to $20. So both investors, investor A and B, are up to $20 a share. Now, unfortunately, due to markets, the potential tariffs that we're hearing, slowdown in the economy perhaps, stock falls from 20 to 15. That is our next dot right there. Investor A decides to take his profits at that point and sell, even though it's a 25% decline and obviously down a lot from the high. They want to take their profit because they feel that that's what they should do out of fear, out of panic. Well, what happens? We continue to have the ups and downs of the market, and the market falls down to a price of $12. It continues to fall, as you see on our next dot on the chart. And at that point, investor A tells investor B, you see, you should have sold. I saved myself another 15%. Okay, fast forward a little bit ahead, and all of a sudden we start to hear that a rumor, maybe there are some trade negotiations going on behind the scenes between the US and Canada, between the US and China, US Europe, or anywhere else, US Mexico. And all of a sudden, just based on the rumors alone, and we've seen this happen many times, stock goes from 12 back to 15, maybe takes a day or two. And now all of a sudden, investor A and B are roughly at the same point. But investor A has sold at $15 a share, whereas investor B is still holding the stock. So investor A is out of the market. Investor B now is sitting there going, well, I'm no worse for wear. This is an important part of this chart because if investor A were to get back into this stock before the price goes back up to 15, then selling at 15 would have been a great move, very smart move, perhaps a lucky move. But if they wait too long and they wait till that stock goes back to 15, if it does, then they're no better off. And in fact, now you have the next part of our chart where stock goes back to its previous high because trade talks are actually now confirmed. It's a confirmation that President Trump has now spoken to Prime Minister Carney or whoever's in power in Canada at that time, the end of April. And now the trade talks are confirmed with Mexico and the European Union, and it looks like things are progressing. But every day, of course, there's a different headline. It's progressing, it's not progressing. So investor A, again, is like, well, maybe I shouldn't jump in because how do I know this is not a head fake? Investor B is along for the ride, and now the stock is now at $20 a share, back at its all-time high. The last part of our chart is kind of the point where agreement is now in place. The United States and Canada come to some sort of trade agreement. The United States comes to many trade agreements around the world. The stock jumps up from $20 to $25. And now investor B looks back at investor A and says, why'd you sell? And investor A says, well, I was nervous. I saw a lot of negativity. I saw a lot of storm clouds on the horizon. And so I panicked and sold when that wasn't the right thing to do. Stock XYZ turns out is a fantastic company, good quality company, best in class name, should be a name that you could hold through the ups and downs. However, let's say you're an investor and let's say you decide to sell at $15, but let's say instead of removing your money from the market, you move into a new name, perhaps a name that has dropped in value. And this is important because this is what I try to do. If I have a B class name, I can maybe move it to a A class name, a better quality name that perhaps has fallen more. So instead of coming out of the market, you go into a better quality name once you sell, in this case at $15, and now you're in a better quality name, but you're still in the market, which is important because when things get better, and they're going to get better based on, in this case, political reasons, nothing to do with the individual stocks themselves, just the environment gets better for trade, and that spills over into the stock market, the good feeling between countries, and the stock market runs higher, and with that, a stock runs higher with it. So getting out of the market, in my opinion, is the wrong thing to do. If you want to sell to upgrade into something else, that makes sense because you're still in the market and you can still ride this wave higher. So the second comment I get is, can we sell? Should we sell? And the answer is no. If you're in the market for growth, and if you know that you're selling because to get back in later on, then I wouldn't be a seller. If you're selling to remove yourself totally out of the market and never go back in, that's a different story. Perhaps you have enough money to live off of in retirement, and you don't need to look for growth in your portfolio, then maybe you could sell and stay out of the market. But it's getting back into the market. That is the most difficult thing to do. And our third and last question that I get and have been receiving most often is this whole idea of trying to look for Canadian investments versus U.S. investments. Should I be selling my U.S. investments and moving into Canadian ideas? And my answer to that is no. I don't think that's a good recipe for success. Canada makes up 3% of the world's markets, whereas the U.S. makes up 20+% of the world's markets. How much money is in Canada versus the rest of the world? And so with that, a lot more opportunity to make money outside of Canada than inside. Now, I'm not saying to have only global investments. I'm saying you need a mix. Maybe you have some inside Canada and a lot outside of Canada, based on this idea that there are a lot more ideas to find in the US and definitely other parts of the world. Before we move on from our first segment, I think we have our best chart of the show, and let's put that up. Timing the market. And this is something, again, talking about selling to get back in. And here you have value of $10,000 invested in the S&P 500 for the last 20 years between 2003 and 2022. You see at the bottom, what it says is if you've invested all days, didn't pull your money out of the market, your $10,000 would grow to just under $65,000. If you missed just the 10 best days in the market, just 10 days out of over 3,000 days, your return would be cut by more than half, 29,708. And then the illustration keeps going. You missed the 20 best days, 17,826. Missed the best month or 30 days, $11,700 as compared to 64,800. And then it goes on. If you missed the best 60 days, well, your 10,000 ends up being worth 4,205. So you start getting into loss situation. So understand that just 10 days in the market in 10 years can mean so much to your portfolio. You ask when those 10 best days come? Well, 10 best days usually come when after the 10 worst days. So at the bottom, you see when the 10 best days came. 2008, October 13th, October 28th, 2008, during the height of the financial crisis. 2020, March 24th, COVID. March 13th, COVID, 2020. Again, March 2009. That was the bottom of the financial crisis. The market took off from there. So if you were a seller at that point, boy, were you upset. And then you can see all the dates, April 2020, November 2008. And there you have it, right? The best days came at the worst times. So if you are fearful, you're never going to be in the market during these days. You have to stay the course, stay confident, continue to own best-in-class names. To me, that is more important than trying to figure out, should you get out of the market? Should you buy Canada versus US? Just buy quality. Buy quality, and you won't have to worry about your time horizon. If you need growth, if you're looking for growth, you can still have growth in retirement. Everything doesn't stop when you turn 65 and retire. You still have money invested year after year that needs to be invested wisely in good quality investments. So those are the three things that I've been asked most often. And hopefully, if any of you have had these questions on your mind, hopefully I've answered this question for you today as well. Now we come to the show that I get asked a lot about, which is our top 3 ideas for individual investors to focus on before you make your investment decisions. Number 1, tariff details to be unveiled today. As I said off the top of the show, President Trump's Liberation Day. Don't know what they're being liberated from, but a lot of people get it confused with Independence Day. A great movie, but I'm not so sure they're the same thing. We'll talk about tariffs and what is perhaps going to happen at 4 p.m. During his announcement in the Rose Garden, I believe, at the White House. Jobs and inflation updates or data coming out. We're going to get jobs data this Friday out of Canada and the U.S., and we're going to get inflation data out of the U.S. I believe mid next week. We're going to get PPI, CPI, consumer products. We're going to find out if what the inflation situation looks like. It's been ticking higher gradually, but with the tariffs coming and tariffs are already implemented in some areas of the economy, is this a cause for concern? Is inflation rising? Our third point, should investors be looking to big tech at this time? And I put this there because if you look at the Magnificent Seven, and everybody just all of it right away moves to the Mag 7, and believe me, there are a lot more tech stocks than just the top 7 names that we talk about often. But the Mag 7 is down double digits this year as a group. I think only Meta is higher for the year. And if you look at the other 493 stocks on the S&P, they're basically flat for the year. Maybe I think even up a fraction. So you can clearly see that it's been tech and the Mag 7 that has been hit. So is this an opportunity? We'll talk about that as well. So let's move on to our first topic, the tariffs. And what's going to happen, I guess, at 4 p.m. this afternoon or slightly after 4 p.m., they're going to unveil, the president that is going to unveil his reciprocal tariffs. So whatever the country, a country has as tariffs or VAT tax or anything like that, that they put on goods, American goods coming into their country, well, the U.S. is now going to reciprocate in some format. We're just not sure yet, but there's a talk that it might be just a straight 20% on anything coming into the U.S. It might be more detailed, country by country, or it might be even more detailed than that, sectors within countries, certain like lumber or dairy or energy. They may all have different tariffs put on them. A lot of work, I'm sure, for Howard Lutnick, Secretary of Trade, and I'm sure he's quite a busy guy right now, trying to represent what President Trump wants to do. Our first chart here shows Trump's tariff timeline. We've gone through this, so we'll go through it again very quickly. 25% tariffs on Mexico and Canada on non-compliance USMCA. This is the left side of our chart. This is already in effect. 10% on Canadian energy, 25% on steel and aluminum, and 20% on all Chinese imports. Scheduled to go through today, April 2nd, 25% on all imports from any country buying Venezuelan oil. Now, this is a great one because the United States is also perhaps hinting, or they've said they might do the same thing with if the Russia-Ukraine situation doesn't, if they don't get a ceasefire and the U.S. cannot come to some sort of resolution, they're thinking about perhaps doing the same thing with Russian oil to force Russia to come to the table. So that's interesting to consider. We're going to have reciprocal tariffs, as I said today. Canada and Mexico tariff pause lifts. This is also interesting. We talk about stacking. Well, will the pause on Canada and Mexico tariffs, will that end today? And so everything will be tariffed. On top of that, you have steel and aluminum tariffs. You have energy tariffs on top of that. So you get 25 on top of 25, maybe on top of 10. It just keeps growing and growing and growing. So we'll hopefully know more about that. 25% on autos. A lot of issues there. As we know, automotive parts. Looks like they've delayed that. So tariff on parts won't come in until beginning of May, 25%. I think the problem with that right now is that for the president, for the U.S., they're finding it difficult on how to tariff parts because, as we know, one part can cross the border between Canada and the U.S. 6, 8, 10 times before it actually goes into a car. So a big problem, I think, to figure that out. And obviously, with all this information, there's no wonder that stocks are falling. And the biggest losses have come in the NASDAQ, in the tech area. We know the S&P 500. We showed that chart off the top. S&P 500 is basically down about 4.5% year to date, down about 8.5% from its all-time high reached end of January, mid-Feb. The NASDAQ down 9.5% from Jan 1, down about 13.5% from its all-time high. And the TSX, which has a lot of gold stock on it, and we know gold, we're going to talk about gold a little later, but gold has helped keep the markets high in Toronto. And we actually see that the TSX for the year is fractionally higher, but down about 3% from its all-time high. So markets have been able to weather the storm. Individual stocks, not so much. We have our next chart here, top companies see sharp market value declines in the first quarter. And I'll read out some of the stocks. Berkshire Hathaway is actually showing an increase, but then you get Meta Platforms, which is basically flat. Saudi Aramco, oil companies down about 4.5. But then you get into the big tech names. Microsoft down 11, Apple down more than 11, Amazon 13, Alphabet, or formerly Google, 18. Nvidia stock, largest chip maker in the world, talked about it on our show many times. They're down about 19-20% for the first quarter. Broadcom, almost 28%. And Tesla. Everybody wants to know about Tesla and Elon Musk. Just heard this morning that the president announced that Elon Musk will go back to just being a CEO at some point in the near term, that he is no longer going to be working for the government. I guess it's because his stock is down almost 36% from the start of this year. So a lot to parse through. The tariffs, we need to understand what's going on. Hopefully, the announcements at 4 p.m. this afternoon go a long way to give us some clarity and certainty into what's happening, and that will hopefully help the markets. Second point that I want investors to consider before you make your investment decisions over the next couple of weeks is the jobs data, inflation data coming out over, jobs will come out on Friday, Canada and the US. Our first chart is a chart about US jobs. You can see US jobs have dropped from the highs of late last year. Jan, Feb numbers were okay. They show, I'd say, fairly good numbers, but not nearly as high as what we saw at the end of last year. If we see jobs data, jobs numbers really fall for the month of March, that could bring some fear to the market. So I think you want that Goldilocks scenario, not too high so that we have inflation scares, but not too low so that we have growth scares out of the US. And lately, I think the growth scares have taken over from the inflation scares. I think everyone is in agreement. If we can somehow not tariff everything going into the US and Canada from each other, that will definitely go a long way to keeping inflation down. Jobs numbers, our next chart, we can see February, we basically had next to no growth of jobs. We can turn the page over there. So we have jobs, there it is, Canadian employment change. February, basically flat. We had January numbers, a lot further down, a lot less than December. Still higher than November, October, September, and August. So still pretty good numbers for the month of January, but February was a pretty big runoff. Will we continue to see jobs, I guess, stagnant or no growth at all? Our next chart, we've had this chart many times. U.S. Consumer Price Index, as I said, we're going to get inflation data in roughly about a week's time. And what that's going to tell us right now, we're seeing inflation as you see it here, 3.1 on core, 2.8 on headline. If we go to our next chart, PPI, which is wholesale prices, you can see that we were starting to see some ticks down on a monthly basis, which is our first chart. Looks like on a 12-month basis, our second chart, chart 2, again, still coming down slightly. So that's a good thing for the Federal Reserve. And I'm sure central banks, Bank of Canada would like to see that as well. So if we do get these reciprocal tariffs, and if they are more severe than we're hoping for, everyone's going to look at these numbers, the PPI, the CPI, the PCE, personal consumptions and expenditures numbers. These are the data that central banks, the preferred data by the Fed, the PCE, what we're going to look at to see if inflation is becoming an issue, and definitely something that we need to focus on before we make your investment decisions. Our third and last point, well, this is the idea of, should we go back to tech? Should we go back to some of the Magnificent Seven? There they are. I would say tech is still the biggest, by far, component of the S&P 500, largest sector of the market in general, the economy, fastest growing. So I think when you see this sector down by quite a bit, and it has been the biggest decline, as I said, the Nasdaq's down the most, tech is down the most. Yes, I think you can circle back to some of these tech names. Now, I don't want you to extremely overweight them. I think you can be market weight. And so basically, if the market is 40% tech in the S&P 500, should you have 40% tech in your portfolio? Well, I'm not so sure, but I think you should have a fairly good size or a nice size component in your portfolio. We have a few charts here showing you the decline of some of the Mag 7 stocks and one other stock. The first one is Meta. You can see the chart here in Meta. Once a $740 stock. Today, 580, 590. Unbelievable decline. Broadcom, not on our list of the Mag 7, but maybe the Super 8 or the Batman stocks, whatever you want to call them. Batman, we had that on our show a few shows ago. Broadcom used to be a $250 stock. Today, under $170 for one of the best companies in the world. It reached the $1 trillion mark, no longer $1 trillion market cap, just growing in the AI space, custom chips, etc. Unbelievable, and competitor in some cases to NVIDIA. Our next chart is Microsoft. Once a $460 stock, today just above $380. Again, Microsoft, I've always said, in my opinion, the best company in the world. They have business in all areas of growth, whether it's cloud, AI, software, hardware, their suite of office products. They're in gaming, social media with their LinkedIn product. They're just everywhere. And so to see a stock like this fall as much as it has, could this be an opportunity for individual investors? I think so, for the right investor that can handle the volatility. Alphabet, our next stock, once a $207 stock, under $160 in the last, well, I guess in the first quarter of this year. Unbelievable decline as well. And lastly, our favorite stock, we show this stock all the time, Amazon. Amazon is probably one of the most diverse companies. They have their hand in everything from groceries to pharma to just selling everything to AWS, which is their cloud business. They're in AI with their AI products. Amazon is truly a magnificent and well-diversified company. This stock was once a $242 stock. Today it trades at about $192 when this chart was taken. So these are the ideas. And as I said, I'm not sure you want to own all of them. Maybe you own just a couple. If you already own them, maybe you want to add to them. You want to stay diversified. So I'm not saying to pile into tech only. You have to stay diversified. But to me, tech right now is something you could circle back to because I think it is undervalued in many of these names that I've already shown you, plus many others. So looking at tech, keeping obviously an ear on what's going on with the tariffs at 4 o'clock this afternoon, and of course, jobs data on Friday and inflation data next week. These are all the things that I think individual investors should be focusing on. Potential outcomes for the tariffs, meaning, I guess what we mean by that is when tariffs, let's say assume tariffs are put in place to some degree, what is going to come of it? What are two things that are fairly certain, in my opinion, that are going to come from tariffs? Well, one, of course, and I've said it already, is inflation. I don't know how you bring back manufacturing to the US from places like China, from places like Taiwan, Vietnam, other places like that, and produce the same product at just as cheap a price. Prices are definitely going to go higher. We have a chart that will show in a moment about why that is. But I just don't see how you can bring back business, how business can come back to the US and prices don't go higher. And forget about just the product alone and building and making the product. What about labor? You know, when you think about labor, how many workers can they find to fill these factories? If you're going to bring back all these factories to the US, whether it's in the auto or steel or whatever business, where are you going to get the workers? The United States right now, just above 4% unemployment. According to the Fed, they're pretty much at full employment. Yes, I'm sure you can always, fill jobs and get workers, a few more workers. But in some states like Wisconsin and others, unemployment rate's like 3%. Where are you going to find the people to fill the jobs? A lot of these jobs and a lot of these things have been produced. A lot of these products have been produced outside of the US for good reason, to keep costs down, because they don't have the manpower, the workforce to do some of these jobs. So they outsource to Canada. Canada does it and they bring it back to the US. And once upon a time, that worked well. It was a great supply chain and everybody was happy and it was business as usual. They did the same thing to Mexico. They do things with other countries around the world, that is the US, and everything was great. But when you bring things back to the US, I just don't see how prices are not going to rise. Our first chart here is a chart, median long run inflation expectations climbed in 2025. So the most important thing on this chart, if you look at it, you can gradually see the expectations rising. But if you look at the far right-hand side, you see that upward slope, that tick higher. That is telling us that or not everyone, but investors and economists and most believe inflation is on the rise. So one thing for certain, if President Trump wants to bring back manufacturing, wants to tariff all the goods coming into the US, one thing for certain, the consumer in the US is going to be looking at higher prices. There is no doubt about that. And I just don't see how that will not happen. The second point that I wanted to make, and something that I think is inevitable, is this decline in oil prices. So you're going to have an increase in inflation and a decrease in oil prices. Now, why do I say that? Are they sort of related? Well, they are. And how they're related, and we can show the chart of Brent, monthly Brent crude oil. There it is. You can see the expectation. Brent crude is the European oil, or let's call it global oil. The rest of the world looks at Brent. Us in North America, we look at Western Canadian Select in Canada, but we also look at WTI, West Texas Intermediate oil in the US. So we always look at WTI. This is looking at Brent, but if Brent comes down, all the other oil prices will follow with it. But why do I think oil is going to come down? Well, the president has said to fight the inflation that he knows is going to happen in his country, he's going to do his best to bring down the price of oil, to get OPEC to produce more oil, for the United States to produce a lot more oil. Whether they can or cannot, I'm not sure. They already produce 13, 14 million barrels a day, by far the largest producer of oil. Maybe if they get the Saudis and other OPEC nations to produce more, maybe the price of oil falls to where he would like to see it, he meaning President Trump, somewhere around $50 a barrel. You bring down the price of oil, that hopefully will bring down inflation. And as we know, oil prices kind of seep into everything we do because we're always transporting goods by plane, by truck, and even people, right? We go to the pumps. Still, most of us don't own an electric vehicle, and we pay gasoline prices. And if oil comes down, that puts more money in our pockets so that we can spend it and in the economy. So I think two things are going to happen with these tariffs. Number one, I would say you're going to see higher prices, not only in the US, but unfortunately here in Canada as well, because we're going to reciprocate. We're going to put tariffs on US goods coming to our country. I'm not so sure that's the right thing to do. We're going to talk about that in just a moment. I think we should look for other things to do other than put on reciprocal tariffs in Canada. But that's what's going to happen. Prices are going to go up. And you're going to hear more and more about the President of the United States try to battle inflation by bringing oil prices down. So two things that are certain that are going to come from all this tariff talk. And unfortunately, maybe oil prices coming down is a good thing, but higher prices in general, inflation, is definitely not. Make Canada a tax haven. This is an interesting idea, and I said off top of the show, one that was brought forth by economist David Rosenberg. He sent it out in a tweet, and we can put up his tweet right now. And he says, the best way for Canada to respond without triggering a new chapter in the trade war is to embark on a massive cut to top marginal tax rates on incomes of all sorts, personal, corporate, and capital gains. Take a feather out of Ireland's cap and make Canada a tax haven. One way not to just prevent capital flight from leaving, right, from capital flight by triggering an investment boom, you're going to keep capital from leaving the country, but you're also going to make business, so you're going to make business think twice about, as he writes, make the business sector think twice about relocating without hurting consumers, which is what tariff retaliation would do. As I said, you retaliate with tariffs in Canada, that just hurts our consumers. But if you lower taxes right across the board, make it enticing for individuals to keep their businesses here, Who's going to want to move their business back to the United States if they're getting a very good tax rate here? Who's going to want to move to the US in general? We're hearing a lot of people moving out of Ontario. Ontario, actually, the most people in Canada are moving from Ontario down to places like Florida. And we see that all the time. Why would they move if we have lower taxes here, or if we lower our taxes significantly enough to keep them here? So making Canada a tax haven, I don't know if we would go that far, but definitely lowering taxes is a great idea that David Rosenberg put forth. And going tit for tat with respect to tariffs only angers the president and President Moore in the White House. He's already said if we tariff electricity, he's going to put 50% tariffs on Canadian goods. We don't want that. But if we lower our taxes, the president won't be able to do anything. He'll have to match or be not as competitive as us. So lowering taxes, maybe that's something that our politicians should consider. I know we have a federal election right now. We've heard Mr. Poilievre talk about cutting taxes in some areas. Just don't think he's talking about cutting enough taxes. And Mr. Carney has hinted at cutting some tax, but not as much as Mr. Poilievre. Perhaps Mr. Carney should consider cutting taxes as well, even though I know that's not what liberals normally do. But I think conservatives can cut tax, can cut even more than what Mr. Poilievre is doing. And in my opinion, producing a tax haven or an environment where we pay less tax, I think is the best way to combat the tariffs out of Washington. So all these tariffs, what are they really designed to do? And we know, right? We now know it's designed to bring back manufacturing to the US. And as I said earlier in the show, that is going to be very difficult. And I actually have a quote here. I'll read it. The US remains the second largest manufacturing country in the world today, but its global dominance has been well and truly lost. Over the last 50 years, manufacturing share of GDP in the US has shrunk from 27% to just 12%. And the starting point of this decline began well before this current time period that we're in now. So the US remains still a manufacturing power globally. But you can see by this quote and by this data that they're nowhere near what they used to be. Our first chart shows this, shows manufacturing industry as a share of nominal GDP or growth. And you can see how much it's come down just in the last, well, let's call it 50 years, since the 70s, 80s, and it continues to fall. So yes, if you compare it to others, perhaps the exception of maybe China, US is number 2. I'm going to guess China is number 1. And, they continue to be number 2, but obviously not as much manufacturing done in the US as it used to be. Our next chart, US employment in manufacturing. You can see here this goes from January 1939 to June 2019. And you can see it once was a lot higher, employment in the manufacturing space much higher. In the last 10, 15 years, it's actually gone up, which is good to see. I'm sure the president is happy with that, but he wants to see more. And it is very difficult just to turn a switch or flip a switch and think you can become a manufacturing powerhouse again. The economy in the US has gone from manufacturing, like back in the 70s, to a services economy. And we see that with our next chart. We can put that up. Contributions to percent change by industry group, GDP 2024. I know it might be difficult to see the left-hand side, but the right-hand side, all those yellow bars, that is private services. That is services economy. The blue are goods, production. So you can see construction, durable goods manufacturing, mining, agriculture, forestry. But these are all small things. What's at the top? Real estate and rental, leasing, professional, scientific, and technical services. These are healthcare and social assistance. This is what the US economy has become, a services economy. To bring back manufacturing will be extremely difficult. It's going to take a lot longer than the president has. His term is up in less than 4 years. I know there's talk. He's been talking that he wants to stick around for another 4 years, and we'll have to see if he's able to do that. But according to the law, that's not going to happen. So these things are going to take many, many years, and they're going to happen a lot long after President Trump is in the White House. Again, another great chart that we have today just pretty much encapsulates why it's so expensive and why manufacturing has left the United States. Why is it so expensive? There you have it. Average salaries comparing US, China, Vietnam. Look how high the salaries are in the US on the left-hand side. That's for machine operator salary, production worker salary. Look how much higher. So if you can hire someone for a quarter of the cost, a tenth of the cost that you would hire someone for in the United States, how can a product be anything more than more expensive in the US to produce it? On the right-hand side, average salaries in selected countries for production managers and supervisors. Look on the far left, the green, that's the United States. United Kingdom, not far behind, the Western world, followed by Germany, Spain, France. But once you get down, Thailand, China, Brazil, Malaysia, Mexico is one of the lowest here on our chart. How can you possibly compete? How are you going to bring back manufacturing to the United States when the costs that go into building a product are so much more? And by just tariffing everything coming into your country, the equipment, the pieces, the individual components that go into making a car or whatever you're making, if those are now 25% more expensive, well, your pricing is still just a lot higher. So bringing back manufacturing to the US, I believe, is going to be a lot more difficult than President Trump believes it's going to be. Even though we are seeing some businesses opening up factories in the US, I think it's going to take a lot more years or many more years than what the president has under his current term. Quick hits, part of our show that I talk about three things in the news lately that many people have perhaps seen. First one, gold rises to another record as anxiety grips the markets. Gold is well above 3,000 an ounce. For the longest time, it couldn't get there. And we have a chart we'll show you on that shortly. Global stocks trounced the U.S. during the first quarter. Is American exceptionalism in trouble? For the longest time, being American, the American dream going into the US, it was fantastic. Stock market was moving higher as compared to all other stock markets. Well, not the first quarter of this year. Europe basically, did a heck of a lot better than the US. China did a heck of a lot better than the US, something we have not seen in quite some time. And our third point, buy Canadian grows. More US companies say retailers turning away their products. As we know, in Ontario, you cannot find U.S. alcohol. Many provinces have followed from what Premier Ford has done. So that's buying Canadian. A lot of Canadian people do not want to travel to the U.S. We're hearing airlines cutting back flights because they're just empty right now, flights to the U.S. So pretty scary thing going on right now, especially for many of these companies. So let's go to the first one. Gold rises to another record. Our first chart here, there it is, beautiful gold bullion bars. We have our first chart, 24-hour spot gold price. It's a little confusing, but think of the blue line as the close on March 28th. You can see the choppiness. The red, it actually goes higher on Sunday, the 30th. So when the stock market was closed, gold was still moving significantly higher. And last but definitely not least, our last pricing of gold well above, well, even 3,100 an ounce now. Gold is in the green there, going a lot higher. And again, gold is that fear investment. When people are nervous and anxious, they buy gold. And I guess as long as they feel anxious, you could see gold continue to climb. But I think if we get any certainty with regards to tariffs, you could see gold fall $100, $200 an ounce, just like that. So it's something that is definitely not for the faint of heart investor. Our next quick hit is basically the idea that global stocks are outperforming US right now. And we've seen that, and it's really, really prominent in Europe. Our chart there on that we can see that Europe, which is the green line, outperforming the blue, which is the US, and even the red, which is China, has now gone past the blue, which is the US. So it's interesting that the US is kind of causing a lot of this anxiety with their tariff talk, and they've been arguably one of the worst performing markets in the world over the first quarter. So a lot of people questioning President Trump and his methods. And our third quick hit is this whole idea of buying Canadian. A lot of Canadian companies not buying US anymore. There you have it. Made in Canada. Make Canada great again. What would that be? MCGA. And so we should maybe, instead of Make America Great Again, MAGA, maybe we should start our own acronym, Make Canada Great Again. And I think a lot of people feel this way. And perhaps we'll look back one day and say, that point in time where the US went and started to threaten tariffs on us, that was the point in history where Canada became a lot more self-reliant, forged new relationships across the world within our own borders between provinces, and that made Canada great again. And I think that's everybody's hope. So I'll take one question that we received, I think in the last couple of days. I think it fits perfectly with our show today. I'm a nervous investor and I find the uncertainty and dropping markets are making me anxious. Where do you suggest I invest during these volatile times? And I think that's probably a question for everyone watching. You're nervous. Where should you be investing? Well, I think first of all, as I said earlier, I think you have to look at your investment objectives. What do you need or want your money to do for you? Because that will dictate what type of investments you could take a look at. And from that point forward, then you could decide, oh, I want this investment versus that investment. This investment's cheaper than the other one. But obviously, people are going to say things such as dividend paying stocks or something that's going to pay you a good yield. And I think you can start there. But if you need growth and bonds are only paying 3.5%, GICs are paying 3.5%, you're really not going to get growth there. So to answer this investor, where should you be investing? I think what you have to do first is you have to look to see what your investment objectives are, what you need to accomplish or want to accomplish, get out of your investments. And then you can then look at, well, if it's a 7% rate of return, then you must be in the stock market through ETFs, mutual funds, or individual stocks. If you can buy a stock that pays a good dividend, a mutual fund that pays a dividend, ETF, then that is always a good recipe for success. But first decide where you want to be in the market, where you would need to be in some cases in this market, bonds, equities, etc. And then from there, you can make a wise investment decision. So with that, I want to thank everyone for joining me on our show today. I hope we were able to answer as many questions as all of you have. If you have any others, please send me a message, give me a call. I'd be happy to help out and answer your questions on tariffs or the stock market or individual portfolios. It would be my pleasure. And I want to say that tune in again 2 weeks from today, which will be April, I guess that'll be April the 16th, same time, 12 noon, where we're going to continue this discussion, I'm sure, with respect to the markets, volatility, but hopefully we have a little bit more certainty coming later on this afternoon. So until then, I want to wish everybody happy investing.